There's a lot of things that work in the short run. This year something works, next year something different works. There might be a stretch of 2-3 years where technology stocks are hot and it seems easy. But if you're going to do it for 10, 20, or 30 years, or 50 like our founder is still doing, it has to be different. It has to be all weather. It has to be able to survive many different shifts, because some markets are going to be what they call bull markets, which are fun and easy and everybody's making money. Some markets are going to be bear markets where every day you're wondering, why am I doing this? Why am I not just sitting in CDs, making a steady income rather than losing money? But if you're going to get the rewards of the long-term investor, which can be pretty amazing as things compound over 20, 30 years, you have to deal with the pain of the short run. And if your strategy doesn't have some kind of risk control and you're not thinking about how to survive over the long run, you're not going to make it. You know, I look at the people that got caught up in the dot-com crash back in 2000. If you lose 80 or 90% of your money, you're not getting that money back. It took 20 years almost for that to come back. So you have to be very cautious, and that's why we're so concentrated on risk control first. But we have to respect the fact that most of our clients don't have enough time to do that again, to make the money again. So we have to respect their capital. And you know, our main risk, anybody's main risk, is what we call permanent loss of capital. We don't want to do that. So we've layered all these safeguards into the process so that we can minimize the pain. We're going to have pain. Every investment process is going to have bad days, bad years, but you should be thinking long term of how you're going to get through all that, because the rewards on the other side of that are pretty big. And I see a lot of investors that get stubborn. You know, they buy something and they say, I know this is a good idea. Let's suppose they did the homework, which a lot of individual investors don't do. They kind of get stuck to the idea and they don't want to let it go. So they think, oh, I dropped 20% on this investment. I can't sell it now. There's a bit of behavioral psychology, behavioral finance going on. The brain locks on the price that they paid, and they don't want to sell unless they can get back to at least even. They can be making a bigger mistake letting a loss grow and grow and grow. So we try not to be stubborn. We try to be pretty humble. You don't really have a choice. The market's going to make you humble. Just when you think, oh, this is going to be a great idea, that's the one that loses. And the one you think, oh, this is not a bad idea, and that's one of your biggest winners. So, like I said, the market has no patience for stubborn investors or stubborn people. Of course, we listen to some trusted advisors that we contract out with, but pretty much all of our research is done by ourselves. We took what worked for some of the best investors. How did Warren Buffett do it? How did Peter Lynch do it? But we've also come up with a lot of our own techniques and philosophies that we think really help clients grow their money, grow their assets, but do it in a way that's respectful of risk and respectful of what can happen on the downside. And that's basically how we've done it. So everything that we put in a client's portfolio, we've really vetted that idea. Because we're buying the same investments that our clients are buying, if it doesn't work, you at least know we're going to feel as much pain as you are. The way we phrase it is that we eat our own cooking. If something's good enough to recommend to a client, we better be owning it ourselves. We better be buying it at the same time the client's buying it. That's really important to us, that we're in it together with the client.